Hi, this is Daniel, and you're watching Unrivaled Investing, a no hype, mission focused channel trying to find you exceptional companies and unrivaled investments. I'm looking for potential multi baggers, folks. Types of stocks that could potentially go up hundreds or even thousands of percent over time. If you have one top of mind that I haven't yet covered with the video, leave a comment below and a reason why you think the company is unrivaled. If you want to follow my personal journey as I try to buy these potential multi baggers for my own personal account, go to unrivaledinvesting.com. Now today we are talking about macro trends. Usually this channel is about individual stocks and why it could potentially be a multi-bagger. Oftentimes I just say no, it's too hard for me, but sometimes I find ones that are special, and sometimes I also do videos on the macro. What's going on with the macro that could impact the individual stocks that folks are investing in. And here it is. I think it's worthwhile to call out Dr. Michael Burry, who's arguably not only an exceptional investor, he's an exceptional investor in that he's been able to do both micro as well as macro investing. He previously was a very successful stock picker before he became famous. Dr. Michael Burry became famous with the Big Short macro bet on the housing and the great financial crisis. Now he has several other bets going on, and I want to talk about one in particular, his bet on interest rates, that might be starting to play out and how that could impact your personal investment journey. So let's dive right in. So first, to understand, I previously did a video on Dr. Michael Burry's first quarter holdings that was available based on data from a few months ago. So this was as of March 2021, and the main takeaway is that he was effectively betting on chaos. And and this is the previous video here, the all in on chaos. And what do I mean by that? Well, first of all, he was betting against Tesla. These are his large option bets. This is based on the nominal value of the contracts. So here it is. Tesla had a $500 million nominal value of the bet, betting against it. He was betting on Google and Facebook, and he had these bets on TLT and TBT. And to summarize these two, the ones that I've highlighted in yellow, is that those are effectively bets that interest rates will go higher, that treasury bonds will sell off, that US treasuries will sell off. Now, to do a quick recap of some of these top option bets, Tesla arguably since the first quarter really hasn't hurt his performance that much. It's probably flat because Tesla stock really hasn't gone anywhere. Maybe he had to pay some of the time premiums on it. So then you look at Google and Facebook, and this has probably paid off nicely. But then what's interesting, because both Google and Facebook have done relatively well year to date. And then this leaves his bet on treasuries. And honestly, his bet against treasuries has probably performed the worst of his top option bets, as TLT, for example, is up about 10%. He was betting that it would go down with a sizable put position. And the reason why TLT is up so much is because it's inversely related to what the interest rate is doing. So if TLT goes up, that means the interest rate went down. And you can see as of the end of March, U.S. Treasury rates, this is the U.S. Treasury yield curve, was pricing 10-year, 20-year, 30-year bonds between 1.74 and 2.4%. Since then, the yield curve has flattened significantly. We're now going to August data. You can see everything's under 2%. And so, in other words, Treasury bonds actually got significantly bid up in the last few months since the end of the first quarter, where now everything yields across the entire yield curve yields less than 2%, which is pretty radical when you consider the fact that during this time period, you also saw the inflation rate jump up pretty dramatically, one of the fastest rate in decades, and you're effectively at negative real rates. And what that means is if the inflation is 5% and the bonds are only paying 2%, your real return is actually -3%. And so this is a really painful situation. It's not surprising in all honesty, because when you have heavily indebted countries, they need to do this type of financial repression, where effectively you have these heavily indebted countries need to get into a position of negative real rates, because it means the debt balance declines relative to GDP over time, so it becomes easier to pay back. Now, it's surprising sort of to think, well, wait a second, during this same period when interest rates moved higher, when inflation went higher, interest rates went lower. I mean, it's sort of counterintuitive, and I think a large chunk of that, a large part of that, is the fact that during this time you had a Federal Reserve. This is surprising. Like, why is it that inflation goes up yet bond yields go down? That folks are saying, hey, I'm fine with an increasingly negative yield. It almost doesn't make any sense. And I think what's happening here is that you're effectively having the manipulation of the bond market by the Federal Reserve, part of their quantitative easing of $120 billion a month, where they're buying, a large chunk of that is buying Treasury securities. That's pushing down effectively the prices. And so when you have a manipulated market, this is what caused rates to continue to go lower, where they said, oh, okay, the Federal Reserve is going to keep buying. They're not going to taper for a long, they're not even going to talk about a meeting where, the rates are going to, they're going to taper. Hence, rates can keep going lower. Let's keep buying it up. But I think that period might be coming to an end. And that's the key aspect here, which is that this has been brought to you by the Federal Reserve. And is it still possible for them to do that, as you see figures like at the end of last week, where literally U.S. job growth tops the forecast, biggest gain in nearly a year? They're reporting better than expected unemployment figures, now at about 5.4%, which is a pandemic low in terms of unemployment. So it's forcing investors to ask, well, wait a second, can the Fed continue this policy, this radical policy of quantitative easing to the tune of $120 billion a month? And I'm not the only one that's thinking this. Quickly after that strong growth print, that strong jobs print came out, you see articles, opinion pieces from Bloomberg effectively saying jobs strength leaves Fed and Powell with nowhere to hide. A robust July labor report gives the central bank less leeway to maintain stimulus. Expect a less dovish tone from now on. And this makes investors wonder, could this mean potentially a taper tantrum? Okay, so what does that mean for investors? What is a potential taper tantrum? Let me do a quick plug for those that are tuning in for the first time. My name is Daniel. You're watching Unrivaled Investing. If this is your first time tuning in, please make a point of hitting that subscribe button. If you're already a subscriber, I do appreciate that thumbs up. If you want to follow my personal journey as I try to find potential multi-baggers, go to unrivaledinvesting.com. First week of the month, I call out my full portfolio. By the end of the month, I call out a potential multi-bagger. Have a community on Discord where I interact with this unrivaled nation on a daily basis. So check that out at unrivaledinvesting.com. So let's dive in to understand, okay, so what are the potential effects of a taper tantrum? And as you look at a potential taper tantrum, I think you got some clues on Friday of what it could potentially mean, of what it would mean if you start having the Federal Reserve cut their stimulus, cut this quantitative easing of $120 billion a month that has arguably propped up U.S. Treasuries, that has resulted in Treasury yields resulting in increasingly negative real rates. Despite the fact that inflation picked up, these yields are below 2%. When inflation's 5% plus, these yields are below 2%. Does that make sense? And so when you look at this, there were some clues, I believe, from the market, some macro clues from the market on what could potentially go down when you start having tapering. And this is the concern. And so here it is, strong jobs figure. Maybe the Fed no longer has any room to keep up this strong quantitative easing. Maybe they have to start tapering sooner than folks expect, in which case growth stocks might take a hit. And that's why you saw ARKK down 2% on Friday. Same day, TLT, bonds, long-dated U.S. Treasury bonds, down 2% because, hey, they're no longer going to be getting a bid, as sizable bid as they've been getting from the Federal Reserve. And this is a big deal because here it is, the U.S. is running significant deficits, looking at a huge stimulus bill. Then another key aspect, you could look at, these are all like, hey, what are the potential side effects of a taper tantrum? What does a taper tantrum even look like? And what's interesting is the prospect that here it is, the financial sector might actually go up because what they're seeing is a steeper yield curve. So let me go through each of these points. So the reason why you might see growth stocks like ARK, the ARK funds sell off significantly is because a lot of these are no profit, high growth, high volatility names. And their valuation is highly dependent on interest rates. And so if you have interest rates going higher because the Federal Reserve is no longer going to be stepping in the same size to buy back these bonds, then you could have higher rates. And if you have higher rates, then that company in the future that's expected to generate profits 5-10 years down the road, that's really unprofitable now, it's going to be harder to value that company. That company is going to take a bigger and bigger discount because that cash flow that creates the value of this business today, that cash flow is coming 5 to 10 years from now, and you're having to take a bigger and bigger haircut. So that's the reason why, oh, you see a dramatic hit on growth-oriented vehicles like the ARK ETF, ARKK. So then you also see a hit, the direct hit, with bonds. Okay, if people are expecting the Federal Reserve no longer to be stepping up, maybe you get higher rates. Maybe the bonds start to sell off. Not surprising to see TLT nearly down 2%. And so then the last one that I talked about is the financial sector. The financial sector, it's for these major big banks, it's extremely challenging when you have to say, well, wait a second. The yield curve is effectively flat. Everything's under 2%. We're supposed to borrow money. We're getting our money from our depositors, people that deposit money at the Wells Fargos of the world or the Cities of the world, Bank of America. They're effectively paying zero on that, and they're making loans based on the yield curve, a 10-year yield of under 2%. Okay, so they have to make a spread, so maybe it's 3%. That is a very tough position for them to be in. So the steeper that yield curve, oh, okay, maybe you pay 0.5% to your depositors, but now because it's a super steep yield curve for a 10-year loan, you might be able to get an interest rate of, a couple extra percent. And now your business model is a lot juicier. So not surprising to see the financial sector also getting a bid. And honestly, this is part of my background. Previously, I worked at a multi-billion-dollar long-short hedge fund, and from my perspective, this is how the global macro hedge funds are looking at things. They're looking at these trends, looking and saying, oh, they're looking at the price action of these things. They're looking at the price action of, let's say, U.S. Treasuries, of growth stocks, and sort of saying, oh, is this trend starting to play out? And so this is what Dr. Michael Burry has bet on. Clearly, it hasn't worked so far, but I wonder if things are just starting to change and how that could influence investors in the near term. If you want to know how I'm personally, approaching this, go to unrivaledinvesting.com. The reality is, though, that it doesn't change a lot. With each month, I'm looking for potential multi-baggers through thick and thin. I'm looking for the types of companies that I think can potentially go up hundreds or even thousands of percent over time. So if you're interested in following my personal journey, go to unrivaledinvesting.com. If this video talking about Dr. Michael Burry, the latest macro trends, and how you could potentially have higher rates dramatically impact growth stocks or growth-oriented vehicles like the ARK ETFs, ARKK, please make a point of hitting that subscribe button if you're already a subscriber. I do appreciate that thumbs up. Thanks so much for watching.